start saving and putting away for my future. And most of the common ones that are coming out now, especially one of the ones that have been very popular, are either index funds, or the most commonly one that I love now are ETFs. And again, they're the same, but they have a little bit of differences, right? And for me, the common things, index funds are basically. Alrighty, Nets. I come here and I talk about how we're gonna build future wealth and how we're gonna start investing for our futures. The couple of questions we often hear and I get asked is, okay, what should I invest in? Should I start investing in Tesla, Apple, Netflix? We have all these companies that we want to invest in, right? And obviously, as we noticed, as we have been talking about, in order for us to build wealth, and to most likely hope that our futures, obviously, our profit grows and our investments grow, we have to invest in something, right? And I'm only saying stocks, but there's various amount of investments out there, right? You can either invest in real estate, you can rather invest in just the stocks, you can invest in bonds. Now they have obviously blockchain and all these new currencies that are coming out. So investments are countless out there. You got to do your own research. Again, it's not financial advice. You have to go ahead and speak to a financial advisor and find out what best suits for you. But one of the most common ones that I've heard and I fell in love with, and I kind of, my process and my way of investing, everybody's different. If you're like me, I'm just a lazy investor, and I don't really want to have time of dedicating myself of finding out, looking at financial statements and looking at the company's profits and loss and revenue, all these things. Obviously, the time and place for all of that. But if you really want to just get started and you're like, well, how can I start investing? How can I start growing my, start saving and putting away for my future? And most of the common ones that are coming out now, especially one of the ones that have been very popular, are either index funds, or the most commonly one that I love now are ETFs. And again, they're the same, but they have a little bit of differences, right? And for me, the common things, index funds are basically passively managed, meaning one of the one of the awesome things that I found of it was how minimal their costs are to run these, to invest in these funds. Normally, for me, one of my big takeaways earlier in my years when I was an investment advisor was the high fees that mutual funds had, and it didn't seem like a lot, but if you were holding it for, let's say, 15, 20 years, those percentages points would add up and would eat up a lot of your gains. And when we started doing research and you read a couple of books, which you should do due diligence, one of the books that I'm still currently reading, the little common book on the investing book on common investing, by John Bogle. He basically talks about how, and he's one of the four founders of Vanguard, and do research on him. But I heard him talking about it, and he was discussing how index funds / ETFs, they're more cost efficient, and when it comes to investing for the long term, the gains can be great, but if your costs are up there with the gains, then you're really not really netting anything more than what you think you are. So he says the initial name of the game is keeping your costs low when investing, and that's why it makes index funds and ETFs so I would say popular, because the investment expenses and costs are a lot cheaper than a basic, your regular mutual fund or any type of equity fund out there that we would go and search a manager for, or a fund manager for, right? Most of these funds, index funds, are ran by obviously computer algorithms, and they're just indexing, they're keeping up with the 500 index in the stock market, right? And they kind of mimic that those the charts and the returns. So you're not going to be first of all, you're going to be more diversified. You're going to have a bunch of companies like Apple, obviously Google, Facebook, all these companies that are up there in the S&P 500, and obviously the big banks and stuff like that. So every fund has the names of the companies holds. There's a bunch of companies that you can also go and look for. You have obviously Fidelity. Not for my personal preference, but I have Vanguard. We have I'm trying to think right now. We have a couple other ones that I could talk about: T. Rowe Price, John Hancock. We have all these other companies that they provide you with different funds and different mutual funds and index funds and whatever it is that you're looking for. But I really wanted to go ahead and talk about why I like ETFs. And I feel like ETFs are a little bit more, for me, I feel like they're a little more flexible because they're basically like stock, except instead of buying one stock, you're buying a stock. Put it this way, you're buying a stock that has a group of companies in it. And basically, if you could buy ETFs of index funds, right, you're buying stocks of index funds in it. And they're more diversified, right? So you're going to have one stock, but that stock has, let's say, 10, 20 companies, whatever it is that is in there, in that portfolio. And you're buying that at whatever that rate is that day. So it's basically like a stock, but you're buying small percentages of these funds. And you're out for the way I look at it is you can easily sell them and buy them at any given time during the day. So you don't have to stay with an index fund. Let's say you have an index fund, you have a net asset value, which is your whole amount of your money in balance. You have to go in there and say how much you want to take out and kind of wait for them to write down the withdrawals, and it takes a process. When it comes to your ETFs are individually held by shares, and then you buy a share by whatever the price is at that market value that day. So, for example, you want to buy 10 shares at $50 a share, you're going to be buying $500 of that ETF. If you want to sell off $500, you will sell off the 10 shares. Now, the price might fluctuate depending on the value of the stocks and the value of the market that day. But for me, I feel like it's more easier for me to, if I need to buy or sell, or if I want to easily take some gains out or whatever it may be. Obviously, it defeats the purpose because you want to hold it long term. But I also like the flexibility and the liquidity of it. Not that index funds are not liquid; they're also liquid as well. But the ETFs, and this is my personal bias again, it's more for me. Is for some reason for me, it's a mental thing. I can kind of see how much shares I'm holding of those funds, and I can kind of see, okay, if I have 100 funds of $50, and obviously I have $5,000, right, of that fund of the ETF, and it goes obviously hand in hand with the same index funds and ETFs with the same risk tolerance. They're following the same funds. They're not as far as different investments. You got to find out which companies they're invested in. But because of that, now there's a bunch of other ETFs that come out. There's obviously there's technology ETFs. There's obviously commodities ETFs. There's ETFs in all different sectors that you want and you focused on. So it doesn't have to be just one, let's say S&P 500 fund. ETFs are in different sectors, which makes it more versatile. I would say obviously more versatile, and you can invest in different parts of the economy, right? It doesn't have to be just in S&P 500 index funds. And there's a lot of index funds as well that just emulate other parts of the markets as well. But for me, I think the easiest thing is I just wanted to go on here and give you guys kind of a breakdown of what should I invest in, or what should I start, or where should I start looking. You want to just start, right? And obviously do the diligence and go ahead and if you're very doubtful, look up a lot of articles online and get a financial advisor if you have to. But a lot of these funds are self-managed, passively managed. You just pick your risk tolerance, what you're looking for, assess your risk, right? And then you just got to be diligent with, buying, putting the money into the fund every month, or every whatever it is that you want to start saving away and putting away, but putting a percentage of your income every month away in those funds and letting those funds just do their compound interest. Again, this is my lazy way of investing. If you want to be a lazy investor, as I call myself, do your due diligence, find out the companies that are profitable out there and doing good. But if you're like me and you want to passively invest and you don't really want to have to, again, start looking for the new trends, the new companies, the new AME, the new type of stocks out there, and you just want to put your money to grow at a long term and hold them, I think passively index funds or ETFs are one of the best ways to let your money grow and build your wealth for the long term. If you have any other routes, if you know about any other ones, let me know. And of course, as long as you're building yourself up and you're growing and you're realizing that you're starting with the actions, right? We're saving and investing in our futures. We have to start somehow, some way. Whatever that is for you, do it. I'm just a lazy guy over here trying to invest passively. So I'll see you guys next time. Stay tuned. Peace.